Imagine you're playing a video game and you find a glitch, a secret combination of buttons that every time you press them puts gold coins into your account. You press the button, you get gold, you press it again, you get more gold. There is no risk, there's no skill. It is just a mechanical flaw in the system that allows you to extract infinite wealth. Now, imagine that the game administrators find out, they catch you, they see the mountain of gold you stole, but instead of banning you, instead of deleting your account, they ask for a small cut. They say, give us 1% of what you stole and you can keep playing. What would you do? You would pay the fine, and then you would go right back to pressing the button. Because it is not a fine, it is a licensing fee. It is the cost of doing business. This sounds like fiction, but in the world of high finance, it is a documented historical fact. The bank is JP Morgan. The game is the precious metals market. And the glitch is a technique called spoofing. In this massive 4-part investigation, we are going to open the files on one of the largest financial crimes in history. We are going to analyze the Department of Justice report from September 29th, 2020. The day JP Morgan admitted to manipulating the gold and silver markets and paid a record $920 million penalty. We are going to explain exactly how they did it. We are going to break down the mechanics of the spoof, how they used high-speed algorithms to create phantom supply and crash the price of silver on demand. And we are going to expose the deferred prosecution agreement, the legal loophole that kept the executives out of handcuffs and kept the manipulation machine running. They call it a crime. We call it the infinite money glitch. This is the story of how the market was rigged. Let's start with the hard evidence. This is not a conspiracy theory. This is not a rumor on a forum. This comes directly from the United States Department of Justice. On September 29th, 2020, the DOJ released a statement with the headline, JP Morgan Chase and Co. agrees to pay $920 million in connection with schemes to defraud precious metals markets. Note the word they used, defraud, fraud. The bank admitted to tens of thousands of instances of unlawful trading in gold, silver, platinum, and palladium futures contracts. They did this over a period of 8 years. 8 years of fake orders, 8 years of manipulating the price to hurt rival banks and retail investors. The FBI assistant director in charge said, quote, JP Morgan Chase and its employees plotted to unlawfully manipulate the markets and defraud those who trade in them. This is as clear as it gets. The biggest bank in the United States, the custodian of the largest silver stockpile in the world, was caught red-handed rigging the price of the very asset they were supposed to protect. But here's the question you need to ask. If they were caught in 2020, why are they still trading today? Why is JP Morgan still the custodian for the largest silver ETF? Why are they still a member of the COMEX because of the deal? $920 million. When you see that number in a headline, it looks massive. It sounds like justice. Wow, the government really punished them. Nearly $1 billion. But in the world of institutional trading, context is everything. Let's look at the return on investment, or ROI. The DOJ report covers 8 years of manipulation. During those 8 years, JP Morgan's precious metals desk was generating billions of dollars in revenue. Traders estimate that the gross profit from these manipulation schemes, the money they made by front-running and spoofing, could be in the tens of billions. Let's run a hypothetical scenario. If a bank makes $100 billion over a decade by rigging the market, and they get fined $1 billion at the end of it, what is their net profit? $99 billion. The fine represents a 1% tax. If you could rob a bank for $1 million and the police said, just give us $10,000 and you can go home, you would be a career criminal. This is what we call asymmetric justice. The penalty does not fit the crime. It encourages the crime. The fine was paid by the shareholders. It was a line item on the balance sheet. Did the CEO go to jail? No. Did the head of the desk go to jail? A few mid-level traders were indicted. But the institution survived. The machine was left intact, and that machine is still running today. So how does the glitch work? How do you manipulate the price of silver without actually buying or selling it? You use phantom orders. Imagine the order book. It is a ladder. On one side, you have buyers. On the other side, you have sellers. Let's say the price of silver is $25. JP Morgan wants to buy silver cheap. They want the price to go down to $24 so they can fill their pockets. But the market is moving up. Buyers are aggressive. So the JP Morgan algorithm steps in. It places a massive sell order at $25.10. Let's say 5,000 contracts. That is 25 million ounces of silver. Suddenly, the market sees a wall. Other traders look at their screens and say, whoa, there's a massive seller at $25.10. Supply is huge. The price is going to crash. So the other traders panic. They cancel their buy orders. They start selling. They front run the big seller. This selling pressure drives the price down. $24.90, $24.80, $24.50. The JP Morgan algorithm watches the price fall, and when it hits $24, the algorithm cancels the massive sell order at the top. It never intended to sell those 5,000 contracts. It was a bluff, a hologram. The order was placed only to scare the market, not to be executed. Once the order is canceled, the wall disappears, but the damage is done. The price has crashed. And now, JP Morgan steps in and buys the real silver at $24. They bought the dip that they created with a fake order. This is spoofing. It is illegal. It is explicitly banned by the Dodd-Frank Act. But it is incredibly difficult to prove in real time because it happens in milliseconds. By the time the regulators see it, the order is gone. The money has already changed hands. And the retail investor who got stopped out at the bottom has no idea they were playing against a ghost. The power of spoofing comes from information asymmetry. The bank knows which orders are real and which orders are fake. You do not. When you look at the level 2 data on your brokerage app, you see market depth. You see the bars representing buyers and sellers. You assume that data is true. You assume those people actually want to trade. But the DOJ report confirmed that thousands of those orders were lies. This means the price discovery mechanism of the precious metals market is broken. Price is supposed to be the intersection of supply and demand. But if the supply is fake, generated by an algorithm that cancels the order before execution, then the price is fake. It is a simulated reality designed to extract wealth from honest traders. The bank acts as the house in a rigged casino. They can see the cards, they can change the odds, and if they start losing, they just create a massive fake sell wall to push the table over. This explains the flash crashes we see in silver. You wake up, and silver is down $2 in a minute on no news. Why? Because a spoof hit the market. It triggered the stop losses. It cleared the book. And then the price recovered just as fast. That wasn't a market movement. That was a harvest. So we know they did it. We know they paid a fine. But why were they allowed to continue? Why wasn't the bank shut down? Why wasn't their license revoked? In part 2, we are going to look at the deferred prosecution agreement. We are going to read the fine print of the deal JP Morgan cut with the government. We are going to explore the theory that the government needs the banks to manipulate the price. That JP Morgan is not a criminal. They are an agent of the state. We will look at the connection between the US dollar and gold. If gold and silver rise too high, the dollar looks weak. Could the infinite money glitch actually be a tool of national security? The plot thickens. Stay tuned for part 2. We are looking at the contract between the bank and the state. If you listened to part 1, you now know the crime. You know that for 8 years, the precious metals desk at the largest bank in America ran a criminal enterprise. They used algorithms to place thousands of fake orders. They tricked the market. They crashed the price. They fleeced the retail investor. And they admitted it. In a normal world, if you admit to fraud, you go to prison. If you or I did this, if we rigged the stock market from our laptops, the FBI would kick down our doors at dawn. But JP Morgan is not a person. It is a systemically important financial institution. And in America, these institutions operate under a different set of laws. In part 2 of this investigation, we're going to expose the legal mechanism that allowed JP Morgan to walk away. It is called the Deferred Prosecution Agreement. We're going to read the fine print of the deal they cut with the Department of Justice. We're going to explore the terrifying reality that the government does not view the bank as a criminal, but as a partner. And we're going to answer the question, why does the United States government want the price of silver to be suppressed? The bank paid the fine, but they kept the license. This is the story of how the sheriff became the accomplice. On September 29th, 2020, JP Morgan entered into a DPA, a Deferred Prosecution Agreement. This is a legal document that essentially puts the bank on probation. The deal was simple. JP Morgan pays $920 million. They admit to the misconduct. They agree to cooperate with future investigations. And in exchange, the Department of Justice agrees not to prosecute the bank criminally. Think about what that means. The government had the evidence. They had the chat logs. They had the trade data. They could have indicted the bank. They could have revoked its charter to trade commodities. They could have shut down the precious metals desk entirely. But they didn't. Why? Because JP Morgan is too big to jail. If you indict the parent company of JP Morgan, you risk destabilizing the global financial system. You risk a run on the bank. You risk a credit freeze. So the Department of Justice invented a middle ground. They extract a cash payment, and they let the business continue. Critics call this the cost of doing business. But it is worse than that. It is revenue sharing. When the government finds a bank for illegal profits, the government is essentially taking a cut of the loot. The bank steals from the people. The government takes a percentage from the bank. The people get nothing. Yes, there was a victim compensation fund established, but it was a fraction of the total fine. The vast majority of the money went into the coffers of the Treasury and the CFTC. This creates a perverse incentive. The regulator relies on the fines to fund its budget. If they shut down the bank, the fines stop. So they keep the bank alive, they keep the game running. They just tax it occasionally. This DPA was a message to every other bank on Wall Street. You can rig the market. Just make sure you save enough money to pay our fee when we catch you. But there is a deeper, darker theory about why the government went easy on JP Morgan. It isn't just about money, it is about currency. The United States dollar is the world reserve currency. Its power comes from faith. Faith that it is stable. Faith that it holds value. What is the enemy of the dollar? Gold and silver. Gold and silver are the anti-dollar. They are the report card on the Federal Reserve. When the price of gold and silver skyrockets, it signals to the world that the dollar is failing. It signals inflation. It signals loss of confidence. Therefore, a rising gold price is a national security threat. If you go back to the 1960s, the US government actively suppressed the price of gold through the London Gold Pool. It is a matter of historical record. They sold gold to keep the price at $35. Why? To protect the dollar. Fast forward to today. The government no longer sells gold directly. That would be too obvious. Instead, they rely on the bullion banks to manage the price. Banks like JP Morgan act as the proxies for the central bank. They sell paper contracts to absorb demand. They use spoofing to cap rallies. They keep the price of real money suppressed so that fake money looks strong. If JP Morgan stops suppressing silver, if they let the price go to $100 or $200, it exposes the weakness of the currency. It accelerates the move out of the dollar and into hard assets. It threatens the ability of the US government to borrow cheap money. So when the Department of Justice looked at JP Morgan's spoofing, did they see a crime? Or did they see a necessary service? Did they see a bank that was doing the dirty work of the empire, keeping the fear gauge broken so the public wouldn't panic? This explains the light punishment. You don't put your own soldier in jail for following orders. You just fine him for getting caught. There's another layer to JP Morgan's dominance. They are not just a trader, they are the custodian. JP Morgan holds the physical silver for the largest silver ETF in the world, SLV. They hold hundreds of millions of ounces in their vaults in London and New York. This creates a massive conflict of interest. Imagine a casino where the guy counting the chips is also playing poker at the table. JP Morgan knows exactly how much metal is in the vault. They know exactly who is buying and who is selling. They have information supremacy. The DOJ report focused on spoofing in the futures market, but it didn't touch the physical side. It didn't ask whether JP Morgan uses the ETF silver to lease out to short sellers. It didn't ask if they trade against their own clients' inventory. By allowing JP Morgan to remain the custodian, the government effectively endorsed this conflict. They said, it is okay for the fox to guard the henhouse as long as the fox pays a fine every 10 years. This allows JP Morgan to maintain a stranglehold on the physical supply. They can see the flows. They can front-run the shortages. They can use their physical hoard to backstop their paper shorts. This is the infinite money glitch in its purest form. You control the vault, you control the paper, you control the price, and if you get caught cheating, you write a check and carry on. The DOJ report revealed something else, the culture of the trading desk. The chat logs released in the indictment were shocking. Traders bragged about spoofing the market. They called themselves the mafia. They joked about crushing the retail speculators. This wasn't a rogue trader. This was a strategy. It was taught to junior traders by senior managing directors. It was institutionalized. This tells us that manipulation isn't an accident. It is the business model. These banks do not make money by predicting the price. They make money by moving the price. They create volatility where there is none. They trigger stops to create volume. They farm the market like a crop. And the retail investor is the harvest. When you buy a silver contract, you think you're betting on the price of a metal, but you are actually stepping into a cage match with a giant who controls the gravity in the room. The DOJ report proved this. It proved that the fair market is a myth. There is no fair market when one player can place 5,000 fake orders in a second to push the price where they want it. So we have established the history. In 2020, they spoofed for greed. They spoofed to hit bonus targets. But something changed between 2020 and 2026. The market changed. The inventory disappeared. In part 3, we are going to look at the survival pivot. We are going to explain why the manipulation we are seeing today is different from the manipulation of the past. Back then, they suppressed the price to make money. Today, they suppress the price to prevent bankruptcy. We are going to look at the short trap that the banks have fallen into. They sold too much paper. The physical metal is gone, and now they are using the glitch, the spoofing, the suppression, not as a weapon, but as a shield. They are fighting for their lives. The DOJ fine was the cost of doing business, but the next fine might be the cost of existence. Stay tuned for part 3. We are moving from the crime to the punishment. We have established the history. We know that in 2020, the Department of Justice caught JP Morgan red-handed. They proved that the bank was spoofing the market. They proved that it was a systematic strategy to extract profit from retail investors. Back then, the manipulation was offensive. It was about bonuses. It was about quarterly earnings. It was about greed. But fast forward to today, the landscape of the silver market has fundamentally changed. The vaults that were once overflowing are now draining. The industrial demand that was once steady is now exponential. And the manipulation we are seeing today is no longer about making a quick buck. In part 3 of this investigation, we are going to expose the survival pivot. We are going to explain why the infinite money glitch has turned into a life support system. The banks are no longer suppressing the price to buy cheap. They are suppressing the price because if they stop, they go bankrupt. They are trapped in a short position that has grown too large to cover, and the physical metal they need to exit that position is gone. This is the story of how the predator became the prey. Let's look at the trap. To understand the danger the banks are in, you have to understand the difference between a covered short and a naked short. If you're a bank and you have 100 million ounces of silver in your vault, you can safely sell 100 million ounces of paper contracts. If the price goes up, you don't care. You own the metal. You are hedged. This is how the market is supposed to work. But what happens when you get greedy? What happens when you sell 500 million ounces of paper contracts, but you only have 100 million ounces of metal? You are naked short 400 million ounces. For years, this didn't matter. The bank knew that nobody would ask for delivery. Investors were happy to trade paper back and forth. The bank collected fees and managed the price. It was free money. But then came the shortage. Then came the solar panels. Then came the EVs. Suddenly, people stopped trading paper and started demanding metal. They stood for delivery. They drove trucks up to the vault and emptied it. Now the bank is sitting there with 400 million ounces of paper liabilities and an empty vault. They are naked, and the price is rising. In financial theory, a long position has limited risk. The worst case is the price goes to zero. You lose what you invested. A short position has infinite risk. There is no limit to how high a price can go. If silver goes to $100 or $500 or $1,000, the bank owes that money. Let's do the math on the bank's exposure. If a bank is short 400 million ounces and the price of silver rises by $10, that is a $4 billion loss. If the price rises by $50, that is a $20 billion loss. $20 billion wipes out the Tier 1 capital of most institutions. It triggers a regulatory seizure. It ends the bank. So the bank cannot allow the price to rise. They have a solvency ceiling. If silver crosses a certain line, let's call it the kill zone, the bank dies. This is why the spoofing has become so aggressive. In 2020, they spoofed to move the price 50 cents to scalp a profit. Today, they spoof to stop the price from crossing the kill zone. They place massive sell walls not to make money, but to prevent the algorithm from calculating their insolvency. They are fighting for their lives. This changes the nature of the glitch. The glitch used to be an ATM. Now it is a shield. Every morning, the bank traders wake up and look at the physical demand. They see China buying. They see India buying. They see the price pushing up against their neck. So they activate the algorithm. They flood the order book with fake supply. They try to paint the tape red. They try to convince the world that there is no shortage. They hope that if they can keep the price down long enough, maybe the demand will go away. Maybe a new mine will open. Maybe a recession will hit. They are buying time. But time is expensive. Every day they suppress the price, they lose more physical metal. Why? Because of Gresham's law. This is the ultimate irony of the manipulation. By using the glitch to keep the price of silver artificially low, the banks are accelerating their own destruction. Think about it. If silver is trading at $70 on the paper market, but the real fundamental value is $150, the banks are putting silver on sale. They are subsidizing the buyers. When Samsung sees silver at $70, they don't say, "Oh no, the chart is weak." They say, "Thank you for the discount." And they buy more. When China sees silver at $70, they drain the vaults faster. The lower the bank pushes the price, the faster the physical inventory leaves the West. They are draining the very collateral they need to survive. If they let the price rise to $200, demand would slow down. The vaults would stabilize. The bank might survive. But because they are naked short, they cannot let it rise. So they are forced to keep it cheap, which forces the vaults to empty, which guarantees a default. It is a doom loop. They are pressing the gas pedal toward the cliff because the brakes are broken. You might ask, where are the regulators? Where is the CFTC? We know from part 2 that the government views the banks as partners in managing the dollar. But there is another reason the regulators are silent: systemic risk. The regulators know the banks are trapped. They see the short positions. They know that if they forced JP Morgan to cover their shorts honestly, the price would go vertical and the bank would fail. A bank failure of that size would crash the stock market. It would freeze the credit system. It would be 2008 all over again. So the regulators look the other way. They allow the spoofing to continue because the alternative, a free market price explosion, is too terrifying to contemplate. They are complicit in the suppression because they are afraid of the truth. The infinite money glitch has become a tool of financial stability, or at least the illusion of stability. So the banks are trapped. The regulators are complicit. The physical metal is gone. How does this story end? Does the bank win forever? Does the glitch work forever? No, because you cannot print silver. In part 4, the final chapter of this documentary, we are going to look at the end game. We are going to explain what happens when the physical float hits absolute zero. We are going to look at the force majeure event, where the paper market detaches from reality. And we are going to leave you with the final verdict on the greatest wealth transfer in history. The glitch is failing. The code is breaking. And the reset is coming. Stay tuned for part 4, the conclusion of the crime. We have reached the final chapter of this investigation. We have exposed the mechanics of the crime. We have analyzed the corruption of the regulatory settlement. We have mapped out the trap that the banks have built for themselves by shorting a finite resource. Now, we must look at the inevitable conclusion. Every glitch, every cheat code, every manipulation has a limit. You can cheat the laws of man. You can pay off the regulators. You can hide the data, but you cannot cheat the laws of physics. In this final breakdown, part 4, I'm going to show you what happens when the infinite money glitch runs into a wall of physical reality. We are going to explain the delivery squeeze, the moment when the paper market breaks. We are going to look at the force majeure clause that the banks will use to try and escape their liabilities. And I am going to leave you with the final strategy to ensure that when the system resets, you are holding the asset, not the empty promise. The game is over. The players are leaving the table. Let's finish this. For 40 years, the glitch worked because nobody wanted the silver. Hedge funds traded paper contracts for cash profits. They didn't want a 1,000-ounce bar delivered to their office in Manhattan. So the bank could sell the same ounce of silver 100 times to 100 different people. It was a game of musical chairs with 100 players and one chair. As long as the music played, everyone was happy. But now, the music is stopping. Industrial buyers, the entities we discussed in previous videos, do not want cash profits. They want the metal. When Samsung buys a contract, they stand for delivery. When a sovereign wealth fund buys a contract, they stand for delivery. This breaks the fractional reserve model. If 10 people ask for the chair at the same time, the bank has to find 9 more chairs. But there are no more chairs. This is the delivery squeeze. It forces the bank to go into the open market and buy physical metal at any price to fulfill the contract. This turns the suppressor into the super buyer. The algorithm that used to sell paper to cap the price must now buy physical to avoid default. The machine reverses gear. And when a manipulation machine reverses, it creates a vertical price spike. So what happens when the bank realizes it cannot buy the metal? What happens when the price goes to $500 and they are insolvent? Do they accept bankruptcy? No. They cheat one last time. They invoke force majeure. This is a clause in almost every futures contract and ETF prospectus. It states that if unforeseeable circumstances prevent the delivery of the asset, the contract can be settled in cash. The bank will say, "We cannot give you the silver, the market is broken. Here's a check for the last closing price. You get your fiat currency back, but you don't get the silver." And because the real price of silver in the street is skyrocketing, that cash is worthless relative to the asset you thought you owned. This is the ultimate rug pull. It converts hard asset owners back into fiat holders against their will. The infinite money glitch ends by defaulting on the player. This is why I tell you, if you don't hold it, you don't own it. A paper contract is just a bet on the bank's solvency, and the bank is betting against reality. When the paper market declares force majeure, the pricing mechanism moves to the parallel market. The spot price on the screen freezes or becomes irrelevant. The real price is discovered on the street. It is discovered between a refiner and a battery maker. It is discovered between a local coin shop and a stacker. It is discovered in Shanghai and Dubai. We move from a centralized price to a decentralized price. In this scenario, the premium becomes the price. If spot is frozen at $80, but you have to pay $150 to get a bar, the price is $150. The banks lose their power to influence this market because they have no metal to sell into it. Their algorithm has no power here. This is the liberation of silver. So where does this leave you? You are the one who saw the glitch. You saw the DOJ report. You saw the manipulation. But instead of getting angry and quitting, you used it. You used the artificially low prices to accumulate real wealth. You bought when they smashed the price. You took delivery when they wanted you to trade paper. You removed your wealth from their casino. This is the ultimate victory. The infinite money glitch was a wealth transfer mechanism from the public to the banks. But by stacking physical silver, you reverse the flow. You used their suppression to buy a strategic asset at a discount. You turned their greed into your opportunity. Now, as the suppression fails, you are sitting on the only asset that cannot be printed, cannot be hacked, and cannot be defaulted on. You are your own central bank. So, here is the verdict on J.P. Morgan and the DOJ. The system is rigged. It always has been. The fines are just fees. The regulators are captured, the price is managed. But rigging has a limit. You can rig a casino, but you cannot rig a volcano. And the silver market is a volcano. The pressure of debt, inflation, and industrial scarcity is building up under the surface. The banks are trying to cap the volcano with paper contracts. It worked for 40 years. But the lava is starting to leak. We are entering the era where the physical reality overwhelms the financial fiction. The glitch is fixed, the game is resetting, and the new game is played with ounces, not dollars. Subscribe.